Many of you asked me to do a video on VICI properties. This is a popular REIT among a lot of retail investors. Many popular YouTubers actually do talk about this company. It's a pretty amazing company, but I personally came up with a different conclusion from what most people actually think about VICI properties. I'm gonna share all of that here in today's video, and I really hope you actually enjoy it. Now, most of you are actually familiar with the company, but to those of you that are not familiar with it, they own many properties across the United States and even some in Canada. Most of their legacy properties are actually in Las Vegas. They own one of the most iconic, buildings in Las Vegas, something like the Caesar's Palace. They own, the Venetian, Park MGM, Luxor, and many others. And most of you, Mandalay Bay, a lot of popular buildings in Las Vegas. They pretty much own the entire strip, almost. Pretty amazing stuff. Very high quality buildings that VICI actually owns. And there's a lot of things that differs VICI from something like, realty income or triple net or something like the apartment REITs that I actually talk about in my videos. And one of those things that actually sets VICI apart is their indexed inflation protected leases. So most of their leases are adjusted for the CPI. If the CPI goes up, something like 4 or 5%, their lease revenue is actually gonna match pretty much the CPI. This is what they have within their leases. Over 96% of the leases is linked to a CPI escalation over the long term. 96%. Pretty amazing stuff, but this is not the only thing. If you look at the remaining lease terms for something like VICI properties, it's around 42 years. 42 years terms for something like VICI versus most of the triple net lease, which are typically 9 to 11 years. It's 42 years for something like VICI because these casinos, they rent them for the very long term. I actually used to own one stock years ago, but I have never looked at it again. It was called something like MGM Gross Properties, MGP, or something like that. Then I sold it and I've never looked at it again. I've never analyzed VICI actually. I think it went public in 2018 or 2019. But this is pretty amazing stuff. This is mainly what sets it apart from many other kind of REITs is a very long-term lease terms. They also have over 100% occupancies. They have higher same-store rent growth around 1.9%, although the apartments are around 4 to 5%, which is why I mostly invest in apartment REITs. The balance sheet, debt structure is actually not too bad. Over 99% is actually fixed. Nothing crazy in the short term. Most of the debt is due after 32, so the balance sheet is very, very safe. The company is safe, which is why I believe actually a lot of the safe is priced in within the company, which doesn't leave much upside potential for the future. I'm going to talk about it in the end of the video. But one of the things that I normally don't like about REITs is the shares outstanding actually going up. And if you look at the shares outstanding for something like VICI, it went up over 50% from 2021 to 2022, over 50%. This is a massive, massive expansion. Now, if you look at the FFO per share or AFFO, adjusted FFO per share, it did go up, but it didn't go up as much as the shares outstanding. It went up from $1.82 to $1.93, but the shares outstanding has gone up over 50%. Now, this is not a good way to do value creation for shareholders. This is one of the reasons why I'm always a little bit hesitant around REITs. Now, the apartment REITs, they actually don't do that. A lot of them have pretty much flat shares outstanding, but this is what realty income does. This is what triple net does. This is what VICI does. This is just the way REITs actually do it. But I was not satisfied with the massive expansion in shares outstanding, while the AFFO per share did expand, but not as much as I would have personally expected. Now, if we look at the dividend yield of VICI, most of you are buying it for the dividend yield. It's around 5%. 5% is not a bad dividend yield at all. Actually, it's pretty bit higher than the historical average. The highest it traded at was around an 11%, 10.5% actually dividend yield. This was mainly in March 2020. I don't personally believe we're going there. This is a very unlikely scenario, and they do increase the dividends steadily. The dividend was around $1 in 2018. Now it's $1.70. So this is pretty amazing for dividend growth investors. And here comes where the biggest problems that I have with something like VICI. That yes, it's a very safe company. The balance sheet is amazing. The lease terms 42 years. I mean, 100% occupancy. So you can't get any better than that. But if you look at the valuation of something like VICI properties, it's trading around 14 times AFFO adjusted from some operations per share. Now, the historical average was around 14 times. So even after the 5% interest rates that we have, or 5.5%, VICI is not trading below its historical average. It's trading pretty much in line with its historical average. It has held up much, much better than most of the other REITs. And if you look at where I'm trying to price VICI at, if we look at the adjusted FFO per share growth, it has been growing between 10% to 6%. In 2024 is expected 4.5%, but it's mainly between 6% to 10%. Now, I would personally be comfortable with putting in something like an 8% number. But the problem is that I normally try to price in a multiple expansion for REITs. But I cannot price a multiple expansion for VICI because it's trading at 14 times, and the highest it ever traded was 17 times. So I'm not seeing a multiple expansion with something like VICI. I'm only seeing a dividend story, and I'm seeing an FFO per share growth story. And if I just leave the valuation the same where it's at, we just do a basic calculation, and we assume that VICI grows 8% in AFFO over the next 5 years every single year. This is around 40% on the upside, just 8 times 5, 40. This is 40% on the upside, not including the 5% dividends that you're gonna get every single year for the next 5 years. Now, this is actually not bad at all because you're buying safety. VICI is much safer than realty income. It's much safer than most of the other properties, mainly because they have these long-term leases, although they can still default on them, but they have pretty amazing stuff, but you're actually paying for it. You're not getting it for free. And this is the main thing I have with VICI. So I see 40% on the upside over the next 5 years, excluding the 5% dividend, every single year for the next 5 years, which is not bad at all. But I've personally been doing videos on REITs, like realty income, like triple net, and I did say I see between 70 to 80% on the upside between a lot of those REITs. Some of them have 60%, excluding something like a 5.5% dividend, which is why I personally believe VICI is an amazing company, high quality company. It's very, very safe, so you're buying a lot of safety, but I'm not seeing any major multiple expansion with something like VICI. I'm just being honest. Even whenever we had 1% interest rates, the highest the company traded at was around 17 times AFFO per share. So I'm not seeing a multiple expansion story. I'm seeing mainly a growth story, 8 to 10% in terms of the FFO, and I'm seeing a 5% dividend, which is actually not bad at all. But I personally believe if you someone more of a risk taker, I think there's opportunities, better opportunities out there. They have much higher upside potential. And this was my honest opinion on VICI properties. It was a quick video, no financial advice, of course. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.